Okay, so before I just pressed the break button, I said, look, is there a story here? Because on the face value, and we look at it, they're cheap, you got ASX exposure, there can be ways to easily spot discounts and effectively
it's very public information.
Good buys.
Yep.
So back to when I said there's no real story here when you zoom out, but if you start to zoom in and actually have a look, you might create a story.
Yeah, I mean, that's the challenge for us is, and we talked about this briefly as one of the problems that ETF solved was a LIC, there's a fixed number of shares on issue. So fixed pool of capital, it's great as a fund manager because you can manage your portfolio. You don't have to obsess about being able to get cash today. But the downside is that when you want to sell your AFIC share, you've got to find someone else to want to buy it. And so when the number of sellers exceeds the number of buyers, what happens? Well, the price falls.
Yeah. And just pause on that as a teaching point. When we see stock market indices dive in one day, it's because effectively the people are like, I'm not buying, it's too crazy, Trump's just announced this, not buying. But there are, because every day there's market transactions, right? You've got portfolio managers that on this day, every day they need to rebalance, they need to trade. And when there is no people to buy and supply increases and demand decreases, that's when you get a better price.
Yeah.
Or cheaper.
And that's
and that's good if you're buying.
It is.
But if you hold that asset or are trying to sell, that's not great.
That's right. And so with the LIC, if there's more sellers than buyers, the price falls, and it can fall by more than the market falls. So, or it can even fall when the market goes up. So the underlying assets held by AFIC will change with the market broadly, but the price of an AFIC share is driven by the demand. And demand goes up usually when people see the manager outperforming. They often see it based on personnel changes.
Yeah.
And the opposite happens when people see underperformance. And so you get this, you've got two movements happening here. You've got the market movement up and down and the manager performance relative to that. That's your underlying net tangible assets, if you like. And then you got the price of the LIC share itself. And the shell. The shell. And the two move differently. So, and generally, over time, LICs tend to trade at a 5 to 10% discount to the value of the underlying assets. Now, you might say, well, if I can buy $100 of shares for $95, why wouldn't I do that? And the answer is that, well, if you're going to buy it for 95 and sell it for 95, that's the same as buying it for 100 and selling it for 100. So it's only the movement in the discount that matters. And sometimes they trade at premiums.
So any comments, if we have a look here at the pricing mechanism, do you want to maybe explain to people what when they see NTA and NAV stands for?
That's a great question. So when you look at any fund, whether it's an ETF or a
managed fund
or an LIC or an LIT, which is a listed investment trust, the assets that they hold have a market value. And if they're...
So people may not have heard of LIT.
Okay.
So that's a property trust, basically, a REIT.
Yeah, it's a listed investment trust. In Australia, they tend to be more property oriented. Yeah. In the UK, it's used to be the default.
Well, it's the UK, the motherland of trust land, isn't it?
That's right. So
anyway,
you can sort of ignore them, but basically, it's a pool of underlying assets. In this case, mostly shares.
Yeah,
and those shares, their value changes every day, and that's the assets of the fund. So you divide that by the number of shares, and that gives you the net asset value per share. We usually use net tangible asset to exclude any goodwill that the manager might have or other things like that. So NTA is the short number or NAV, and you can broadly consider, for most practical purpose, they're the same thing. They're technically not, but for practical purposes, they are. And so you look at the share price times the number of shares is the market cap, and then you look at the underlying portfolio, and that tells you the net asset value or NTA. And usually in a LIC, they trade at a discount. So the NAV or NTA is usually greater than the market cap. Yes, greater than the market cap. And the challenge for an investor is it's the change in that discount or premium that adds complexity to this. So not only do I have to worry about, well, what's the underlying assets doing? I said, well, what's the premium discount doing as well? And that's why we don't.
But it is a mug's game chasing the spread on the premium discount when you've got LICs, surely.
Yeah. Well, it depends. I'll just say you're stepping over. Well, are you an investor who are buying and holding for the long term, or are you trading to get quick wins? Yeah. I mean, there are trading opportunities.
Yes.
And quite often...
Which trading generally can be a mug's game.
It can. Especially if you're not doing it as your full-time gig. But there are opportunities where, a manager's got a bad reputation. There's a activist shareholder on the register. So the good old... Wham guys, what's his name? But he's a very activist manager.
Right.
And there you can pick up some problem, but you've got to know what you're doing. You've got to be on this every day. That's a trading opportunity rather than investing opportunity.
Exactly.
So I wouldn't be obsessed too much other than the direction of it. So if you see the discount blowing out, that's a sign that the market's thinking, well, maybe I don't like this fund as much as I used to, and you got to think, well, what's the catalyst to turn that around?
I want to talk sexy, and I want to talk taxi.
Yep.
Tax. Now, I actually did have a slide and a table. I'm like, no, it's just way too overcooked. Yep. Let's just talk tax. LICs. We've got an actively managed company that – okay, just on that, I digress. The answer is probably no, but it could be yes. Is Berkshire Hathaway a LIC?
I would say that no, its primary business is as an insurance company, and that the investment portfolio – is employing the capital of the insurance company.
But if I look on an angle and squint a little bit,
I
could be confused.
You could make that argument.
And I did make that argument.
Yeah. I mean, it's a perfectly reasonable argument to make. But when you look at where the profits come from...
he renovates companies.
Yeah, which is really about putting to good use the capital that you have to have sitting around as an insurance company.
Just on that, so if the LIC is an actively managed company, so when it comes to tax, compared to an ETF, it's a product. It's got a PDF, product disclosure statement. This ASX 200 ETF, we pay distributions twice a year. Here's the freaking dates.
Yep.
What comes in, it's going to get spat out, done. Yep. Okay. I'm just going to throw a whole heap out and I'll let you rip. And when I do this signal, Vince, wrap it up.
Yep. Cool.
The LIC, can there be some, I don't want to say, I'll say razzle dazzle.
Jiggery pokery,
where, okay, we've got this, we've sold a portion, we don't want to pay out this as a dividend next month because we're going to do this with it. We can cook the books a little bit with CGT. Can there be some black magic within the LIC? And maybe I'll just throw to you now. I'll shut up. But talk to us about tax.
Yeah.
Between
I
the
don't know
two.
if I'd use the word black magic, but there's a fundamental structural difference that you've got to get your head around. An ETF and a managed fund are both trusts.
Yes.
An LIC is a company. Now, that might sound academic or esoteric, but from a tax perspective, it makes a fundamental difference. So a trust doesn't pay tax in its own right. All of its income and expenses, I suppose, are attributed to its unit holders. So,
Which is the same in trust land, effectively, if you've got a unit trust.
Yeah. So managed funds, ETFs, they're both trusts and they are ignored for tax purposes. So the
beneficiaries pay the tax.
which in the case of an ETF is the unit holder.
Yeah.
And so that means that there is full pass-through of what happens inside that trust box to the unit holder. A company, on the other hand, is a taxpayer. So a LIC will pay tax, and then through the miracle of franking, the benefit of that tax paid is passed on to the shareholders with the dividend. Companies are not obliged to pay a dividend. Usually they have a big incentive to do so.
And I think that was my comment, like on a year-on-year basis, if we can see something on the horizon, they might go at the AGM, hey, friends, we're not going to do a dividend in the next 2 years.
Yeah,
They probably wouldn't, but
and certainly
they've got that discretion.
And certainly that would definitely create a discount to net tangible assets. But that's a fundamental difference. And what that means is that the distribution you get from a trust is a bit more variable because it depends a bit on what's happening on the market. So
you just get spat out what you're given.
So in a year where you have a big exit from the market, from the index, so when Westfield left the index, all of the trusts, all the ETFs who hold the index had to sell that down, create a big capital gain in that year, and you got a big distribution.
There was a capital nature.
Which was largely capital. But the point being is that was a blip. I can't remember what year it was. I don't know if you can either.
It was 2010s?
Yeah, I would say it's a decade or more ago. Similarly, when Sydney Airport was privatised, it left the index. They had to realise
Westfield delisted, 2018.
Okay.
Oh, gosh. Okay.
Well, it's almost a decade ago, I suppose.
Well, yeah. 8 years.
Whereas a LIC, they're not indexes, so they can choose whether to sell or not, and they can choose whether or not to pay that profit out as a dividend. There's a fair bit of incentive, though, to the extent that they have franking credits, to pay them out, because when you look at their balance sheet, the franking credits don't turn up. So they pay some tax, their NAV drops, and that's a potentially complexing thing, which also makes comparing returns difficult.
Yeah, and we will get to returns. But so what I'm hearing, and maybe I will just put up this return slide because it does come into this tax thing. When we are investing, we're investing for the long term. And when we look at the performance of Argo, AFIC and IOZ, they're very similar. So we've January 2000 to April 2025, Argo did around 8.5%. AFI did around 8.7%, which you'd call 8.5%. And the ASX 200 did around 8.3%. Mind you, an index, Vince, an index fund will always perform unless the index after fees.
Almost by definition.
Yes. So having said that, because of the tax and the franking credits and the CGT treatment, it's really hard to get a good grip on what the actual performance has been. Is that a fair statement?
And comparing pre-tax performance, which is what you're looking at here.
Yes.
So when you look at a performance report, it excludes the value of the franking credit. And
there wouldn't be many super funds that would allow LICs, would there? Can you get some like must trusts that would?
Probably.
Anyway, I digress. When we do the episode on retire right on wraps, we'll touch on that.
So the index itself, that's a raw return. So there's no value applied to the
benchmark,
franking
if you
credits.
will.
It is. That's all it is. There's no costs in there. There's no taxes for transaction costs. And so when you receive that 8.3% from the index, assuming you could buy the index, you will also get some value for the franking credit. So if your tax rate is less than 30%, your after-tax return will be higher than your pre-tax return. And that's not shown in these numbers. Now, when AFIC holds, let's say they hold the same shares as the index itself, they will pay tax. And to the extent that they get a franked dividend, that's largely a neutral effect. But where they get a non-franked dividend, they will pay tax. So the AFIC raw reported return has, on average, more franking attached to it.
But a real life example of that is you pull up any super fund, and this is just an example of the tax reporting and franking credits. Look at the find a Australian shares imputation fund or income fund. Look in the accumulation return the last 10 years. It might say 11%. Go to the pension fund, it might say 13% because it's factored in those franking credits.
That's right.
So
because that turns them into cash once you lodge a tax return.
So again, if we zoom out, the returns are very similar, and it also depends on the return of the Argo and the AFIC, what your individual tax return is.
Exactly, yep.
And does a company, do you have an investment company that owns the LIC? Do you own it personally?
Yeah. And it also depends on the nature of the LIC. There are some things called traditional LICs, which is largely what we've been talking about, where they get to pay the franking credits and they pass on a credit for the capital gains.
So I guess in finishing, the MERs, which is the management expense ratio, face value around 0.15 for Argo, around 0.14 for AFI, 0.09 for IOZ. If you had 10,000 invested, that's $15, $14 and $9 respectively. In my world, that's the same. In my world, that's free.
It is vanishing close to zero.
Now, question, with the listed investment companies, can the fund managers or the board, can they pay some type of director fee or something like that and move things around?
There are some costs on the AFIC P&L that don't get counted in the MER. So if you actually took look at their annual report and divide profit by funds under management, you'll get a slightly bigger number.
Yeah.
The last time I did it, it was about 0.03 difference.
Yeah.
So as you say, these numbers are all vanishingly close to zero.
Yeah.
And it's not something you would use to choose one from the other.
Now, on the YouTube, we I've got this slide up, some pros and cons. I'm not going to read them all because I don't know if it matters. And I think my question in the rapid fire finishing for you, Vince, one, should an ordinary investor, if they're not listening to some financial people or reading some financial books, entertain LICs in their portfolio in this day and age? Full disclosure, I don't own any LICs myself.
Yeah. I mean, we don't hold it, and that's for two reasons. One, when you're talking about large cap equities, active management is demonstrably not value adding. Unless you
commodity.
So for that reason, we don't do active management of large caps, and therefore you get pointed to the index and you want to buy an index. The advantages of an ETF win every day. Yeah. If I do want active, we use active for small companies. So there
Would you not just use, if you were going to go down the active road for Aussie equities, why wouldn't you just do unlisted managed fund?
Exactly. Okay. There are some marginal administrative benefits. So if you're trying to do this yourself, A LIC is probably administratively easier. So
if you had bought a LIC on a superhero platform or a B Shares Direct, it's going to do the reporting for you. Yeah. Whereas if you bought an unlisted managed fund, you're in that same boat as buying a direct share. Yeah.
And many of them have minimum holdings. So some of the small cap
maybe 20K.
Managed funds we use 50,000.
Right.
20, 50.
Yeah.
10's fairly common. But that means it's pretty hard to put 5% of your portfolio when you've got a $5,000 portfolio into one of these funds. So that's really why we don't use LICs. I personally don't. But once you move away from the large cap equities, there are some opportunities, but that's probably a story for another day, and that's not where the money is in LICs.
Any final comments about LICs versus ETFs? I think anyone who's listening would probably get the view that it's, I'll call it a technology or a style that really is outdated.
Yeah,
it's the risk of
obsolete technology.
The board of Argo and AFIC having an aneurysm hearing that. But I think obsolete could be the word.
Yep.
Although if you are a gentleman who gets on the odd podcast every now and again and praises them forevermore, amen, it might be better for that person if they're retired from the workforce.
Maybe, yeah.
Maybe, I don't know, in terms of the dividends or the tax treatment.
Yeah, and if you're happy with the movement in the discount premium.
My final question to you, Vince, should we want a return, like if you woke up of a morning and you're like, I just want to invest in the Australian share market. Should we want, as an investor, or seek a return as an investor above the market?
Well, you sort of can't if you believe that a market's efficient. Sorry. Well, the way to get a higher return than the index is to take more risk than the index. So you should, in theory, be able to beat the ASX 200 by buying numbers 101 to 200. You should be able to beat the index by buying the more profitable companies.
But along with trying to get a higher return comes with potentially high risk and high volatility.
Yep. And return is payment for risk. So if you go buy all 200 in proportion to their things, then to beat that, you've got to do something different. And to sustainably generate higher return, you have to take a sustainably higher risk. And is that what you want to do? That's my take on it.
Thanks for the chat today, Vince, on LICs and ETFs. If you've got any comments about LICs or ETFs that we either missed in the episode today or you want to add, pop them in the comments here on YouTube or pop them in our Facebook group. Remember, if you are joining our Facebook group, just put, where did you hear about this? When it says that, just put, I listened to Vince and Glen on the podcast, because then we know you're an actual person and not a spam farm somewhere around the world.
We don't want bots.
We don't. Vince Scully, thank you so much for joining us today. Thanks for taking care of some of my wealth on Life Sherpa Invest. Thanks, friends. Bye.
Invest early, invest often.
Thanks for listening to today's podcast. If you want to support us, there is one way you can do that. You can send the episode to a friend, a family member, or your group chat if you think those people would find it valuable. We also thank you for leaving a review on Apple or Spotify. If you've listened to this podcast for some time, or if you've read any of my books, you would know that giving and generosity in a financial sense is a big thing in my life. If you think it's time that you are ready to give financially to a good cause, you could head to our website, moneypodcast.com.au/charities to see the charities that we support.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the product disclosure statement, PDS, and target market determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective licence holders.